Welcome all to today's webinar. My name's Clark Jarrold. Earlier this year, we expected to be doing this face-to-face, and we also thought we'd be talking about changes in accounting standards such as the new lease standard AASB 16. But with the impacts of COVID, all that's changed. We're now doing this virtually, and we're also going to be talking about the impacts of COVID that are relevant for 30 June 20. So you can see here that we're going to be addressing certain matters, impairments, lease rental concessions, which is an interesting one because the International Accounting Standards Board has probably moved faster than it would normally move in amending a recently released accounting standard, AASB 16. We'll also look at government assistance, some going concern issues, some financial instruments and other issues. Finally, we will talk briefly about some of the new financial reporting issues that you will need to consider this year. Today, I'm joined by a colleague of mine, Cameron Henry. Welcome, Cameron.
Thank you, Clark. We have received some questions from participants in advance, and we'll answer some of those questions as we go through the presentation. But participants should also feel free to send through questions, and we'll endeavour to answer that in the time we have towards the end of the presentation. So let's make a start. It's probably an understatement to say that the coronavirus outbreak is posing a serious public health threat around the world. I mean, we've had over 10.8 million confirmed cases as of today and over 500,000 deaths. It was confirmed as a global pandemic by the World Health Organization back in early March. And we've seen interrupted movement of people and goods throughout the world, and many levels of government have instituted restrictions on individuals and business. And in our own country, we've seen, right here in parts of Melbourne, where areas have been locked down again as a second wave appears to be happening. In terms of the business impacts, we've seen many organisations effectively put their operations into hibernation. I mean, you only have to look at some of the airlines, some of the travel companies, those in the hospitality, tourism sectors, theatres, cinemas, sporting events, just to name a few. We've also seen reduced consumer demand due to lost income, with increasing levels of unemployment, and again, the restrictions on people's ability to move freely. There's also been the disruptions to global supply chains. We've seen renegotiated leases, rent holidays, repayment holidays, and of course, the government support in terms of payroll subsidies like JOBKEEPER. So in terms of accounting impacts, I think it goes without saying actually that FY20 is probably one of the most challenging reporting seasons that I've ever seen. Boards, management teams, accountants, auditors, we're all grappling with how to comply with the accounting requirements given the increased uncertainty. As Clark's already alluded to in the agenda, the financial reporting issues, cut across things like impairment, lease rental concessions, government assistance, going concern, to name a few. So let's start with impairment. When we talk about impairment, we tend to focus on goodwill and other intangibles, and then probably property, plant, and equipment. But the reality is, and particularly in this COVID-19 environment, we need to be cognizant of impairment across all facets of the business, including trade and other receivables, whether we're going to collect those debtors, inventory, where we're always considering whether we're carrying at the lower of cost and NRV, and whether we can really sell that stock at the value of carrying it, or whether we have to reduce it in the current environment. Similarly, our investments in associates, whether we're going to be able to recover our deferred tax assets from future taxable income and the like, exploration and evaluation, all those things on that page. So what do the standards require us to do? I mean, AASB 136 makes it clear that goodwill and indefinite-lived intangible assets need to be tested for impairment every year, and also where there is an indicator of impairment at the reporting date. So all of those companies that have half-year reporting, our listers and other disclosing entities. Also, other non-financial assets like property, plant, equipment, right-of-use assets, etc., they should be tested for impairment where an indicator of impairment exists at the reporting date, which begs the question, so what are these indicators of impairment? Well, they can come from external sources, or they can come from internal sources. So, for instance, there may be observable indications that the asset's value has declined. Again, if you had investments at the moment in airlines, cruise companies, large travel groups like Flight Centre, if you go and look at the share price over the last 6 months, I think you'll see an obvious decline. There may also be significant changes that have an adverse impact arising from market conditions, economic conditions, legal, environment regulation. I mean, even a government decision. I mean, to give you an example of that, some people might recall when Rio Tinto bought a Mozambique coal mine a couple of years ago for US $3 billion, and then impaired the whole thing 18 months later because the government, told them they couldn't barge the coal down the Zambezi River. I suppose the other telltale sign that we often look at as auditors is that last one on the left-hand side, whether the carrying amount of the net assets in your books is more than the market capitalisation if you're a listed company. It doesn't necessarily mean that there's an impairment, but it's an indicator that needs exploring. On the other side, internal sources, it may be just a management decision to discontinue or abandon a project, or decided assets no longer of use and is idle. Other evidence might be that you can see in the internal management accounts that the economic performance of an asset is declining or worse than one expected. So the standards say that an impairment loss is immediately recognised in the profit and loss when the recoverable amount is less than the asset's carrying amount. So what's the recoverable amount? The recoverable amount is the higher of the fair value between a willing buyer and seller less cost of disposal, or the value in use. And it's this value in use that we're going to explore a little bit more, because the value in use requires you to follow 2 steps really. You're estimating the future cash flows to be derived from the continuing use of the asset and from its ultimate disposal. And then you're applying an appropriate discount rate to those future cash flows. The key point is what's in that little blue box there. It says the value in use must reflect expectations about possible variations in the amount or the timing of the future cash flows.
So, Cameron, in terms of that last comment about the value in use reflecting the expectations about possible variations in the amount of timing of future cash flows, how is that actually done? Well, that's a good question, Clark, and that's actually answered on this very next slide. What you're basically doing is you're looking at all the possible scenarios, possible outcomes, and working out an expected present value approach to those cash flows. So you can adjust your cash flows in terms of the timing and the amount. The other thing you can do is you can adjust your discount rate. And the mistake I sometimes see is I've seen people adjust both, the discount rate and the cash flows, and you risk obviously doubling up there. So Clark, what might we expect to see given the current level of uncertainty? Good question, Cameron. As we can see on this slide here, delineates between 2 scenarios, a normal economic environment and a COVID-19 uncertainty as we have today. In the normal economic environment, we typically see a single set of cash flows, which is used in the DCF model, and then a discount rate applied for the level of uncertainty to that set of cash flows. Of course, as we're all aware, the higher the uncertainty, the higher the discount rate. But now that we're in the COVID environment that we're in, where many entities are facing increased uncertainty as to future cash flows, they may need to change that approach. So, so we may see that entities have to model a series of different cash flows to take into account the uncertainties of the future. So as an example on the next slide, we show here that an entity may identify 4 scenarios and apply probability weighting to those scenarios. So for example, consider an entity that operates in entertainment or restaurants or industries such as that. Depending on the length of the mandated cessation of operations by government and also the caution of consumers to visit or to become customers of those entities, there may be multiple future possibilities as to the cash flows. So these different scenarios may need to be considered in assessing those cash flows. Also, in many cases, discounted cash flow models will be significantly affected by the assumptions underlying the length of time it will take for revenue and operational activities to recover from the effects of COVID-19. This can be illustrated by the length of time the V-shape of the operational disruption takes to begin recovering. As you can see on this slide, the amount of uncertainty of this assumption will depend significantly on the jurisdiction or jurisdictions which an entity operates. Think of Queensland versus Victoria at the moment. There may be greater uncertainty in one of those environments, and also the expected time frame for the effects of COVID to begin to decrease. Determining the number of scenarios to include their relative weightings, the key assumptions of the discount rate used in each scenario will obviously require significant judgment. Several points should also be considered in these value and use calculations. The expected effect and endurance of the operational disruptions, i.e. the slope and severity of the V-curve, which we've noted in this slide, which will be affected by the jurisdiction and sector in which the entity operates. Note that the V-curve has been used for illustrative purposes in this example. Depending on the information available at the reporting date and the economic and other forecasts at the time, the curve may be a U or a W in shape. We're yet to see that play out. Also, should be considered is the availability of necessary resources to ramp up operations once the entity expects to be able to increase operations, the survival rate of competitors, and the demand for goods and services during and following the effects of the outbreak. Also, should be considered is not only the demand but also the supply chains.
So Clark, does it have to be these 4 scenarios? Like, I think if I was doing it, I'd probably just have a base case, best case, and worst case. You know, so you have 4.
There's nothing magical about 4 scenarios, Cameron. It could be 2 scenarios, it could be 3, as you've mentioned, 4, or even more. It depends on the circumstances of the particular entity. Now, whilst we're discussing impairment, it's worth noting a change that needs to be made this year due to the new lease accounting standard. In the past, we've had the old lease standard AASB 117, and of course under that standard we had operating leases for lessees which were not on the balance sheet. So in other words, the cash generating unit had no asset recognised for, say, often premises that were leased. So the cash flows in that case were, or the cash outflows in assessing the value and use included lease payments for those assets which were not on the balance sheet. Of course, we've now moved to AASB 16, and under that standard, we recognise right of use assets where in the past we may have had operating leases which were not on the balance sheet. Those right of use assets will have to be included in the cash generating unit. So that changes the considerations for the cash outflows in determining value and use. The cash outflows should not include the lease payments included in the lease measurement. If they were included, that would be double counting. Key message on this slide is that lease payments that are not included in the lease liability measurement, for example, if we think of turnover-based rent or usage-based payments, in other words, variable payments that are not dependent on an index or rate, those payments are still included in the cash outflows in the value and use calculation because they're not reflected in the lease liability, nor are they reflected in the right of use asset. To sum up, key items to consider, many entities will need to perform detailed impairment analyses as indicators of impairment will exist. Goodwill, as Cameron mentioned, may need to be tested more than once. You may have a date at which you test goodwill throughout the 12 months, but if there's an indicator at the reporting date, you also have to test again. Cash flow forecast may need to consider more than one scenario, given the greater level of uncertainty that we are facing in the COVID environment. Obviously, that's dependent on the sector or entity or the industry that you are operating in. Higher levels of uncertainty clearly exist in many cases. However, entities must make a best efforts approach with the information that is available.
So inventories. I mean, as I said earlier, inventories are measured at the lower of cost and net realisable value. We don't typically use the word impairment when we're talking about inventories, but really, when we make that assessment, that things are inventory selling at less than what we're carrying for, when we create a NRV provision, it's effectively an impairment. Another aspect, that many haven't thought about, and particularly relevant to manufacturing companies, is the fixed production overheads, the rent, the depreciation. Where production is decreased, fixed overheads are typically still allocated based on normal capacity. But if production volumes are significantly reduced, this is likely to result in a significant portion of fixed overheads being unallocated. There may be a tendency or thought to try to capitalise this, but the unallocated portion of the overheads needs to be expensed through the P&L rather than capitalised.
So we've addressed a couple of areas of impairment today. We'll also look at financial assets impairment issues a bit later on. Now we're just going to look at some issues around lease rental concessions. As we're all aware, throughout the last few months, many entities have closed down their operations, particularly if you look at retail, shopping centres. If you walk through the CBD here at Brisbane, things have been quiet. So as a result of that, there's been instances where lessees have obtained rental concessions from landlords. The government has even introduced some measures in respect of that, as we're all aware. So what sort of concessions are we talking about? Well, the concessions could be a number of different types of concessions. They could be rent-free periods, deferral of payments, even payments from lessors to lessees. These are, of course, made to compensate the lessees for the impacts of the COVID-19 disruptions, the typical example being in shopping centres. An issue has arisen as to how entities, lessees, should account for these concessions given the concessions that are being granted. Entities would be lessees will be required to go through each lease contract to determine whether the concession was within the terms of the contract or not, given the requirements of AASB 16. If it's not within the terms of the contract, then these concessions would constitute modifications, and modification accounting would have to be applied under AASB 16. This would require that the lease liability be revised or be based on revised payments using a revised discount rate. Also, in revising the lease liability under modification accounting, the right of use asset is also adjusted. The time to go through every lease for a lessee to assess whether it's concession within the terms of the contract may be onerous for lessees who have many leases. Think of lessees that have hundreds or even thousands of leases, and going through each and every contract to try and determine whether the concession is within the terms of that contract or not. That would be onerous for lessees. So the IASB has amended IFRS 16, the equivalent of our AASB 16, to address that. So under the amendment, which only went through in May this year, the lessees have an option from the requirement to determine whether COVID-19 related concession is a lease modification or not. So if they can apply this amendment, then they don't have to go through and determine each and every contract to determine that there's a lease modification. I should specify that is where there's certain criteria are met to be able to apply that modification, sorry, that amendment. And if you do elect to apply the amendment, and you're able to, then the lessees are to account for the COVID-19 related rent concessions as if they were not lease modifications. So I mentioned that there are some criteria to apply this, this exemption or this practical expedient. These criteria have to be carefully assessed to be able to determine whether or not this option to apply the practical expedient is available. So just looking through these criteria, the first is, did the rent concession occur as a direct consequence of the COVID-19 pandemic? The second criteria is, does the change in lease payments result in revised consideration for lease that is substantially the same as or less than the consideration for the lease immediately preceding the change? Thirdly, does the reduction in lease payments affect only payments originally due on or before 30 June 2021? The idea here is to make sure that the concession is attributable to the impacts of COVID-19 and not other matters. So if just looking at that third criteria there, if the reduction in lease payments is for payments beginning from 1 July 2020 through to 31 December 2021, that would fail that third criteria because it's going beyond 30 June 2021. And lastly, the fourth criteria is there any other substantive change to other terms and conditions of the lease? Having gone through those criteria, a lessee is able to determine whether or not the practical expedient is available. If it's not available, then the lessee will have to go through the lease contracts to determine whether or not the concession is a lease modification and apply lease modification accounting or otherwise. If the practical expedient is available, then the lessee does not have to apply modification accounting. The lessee can therefore not have to go through each and every lease contract to determine whether or not the concession is within the terms of that contract. Now, assuming that you do apply the concession, and we'd assume that many lessees will apply this practical expedient if they can. So on the basis that you are able to apply the practical expedient, what's the accounting? Well, here we have one example. So let's assume that we have $100 lease payments per month for 20 years from July 19. The lessor and lessee agree on 1 April 20 to a 6-month rent concession, a waiver. And then what do we do? So first of all, at 1 April 20, the lessee has to assess whether they meet those four criteria I've just been through. If they meet the criteria, then the lessee has to, and they elect to apply the practical expedient. The lessee has to recalculate the lease liability based on the new lease payments agreed with the lessor using the original incremental borrowing rate. And that's a significant advantage of being able to apply this practical expedient as compared to modification accounting, because if it was modification accounting, then you would have to use an updated incremental borrowing rate. But applying this practical expedient, you're able to use the original incremental borrowing rate. So you redetermine the lease liability. You compare that to the old lease liability, or the lease liability as it was with the previous payments, and the difference, which should be a reduction in the lease liability, will be recognised immediately in profit and loss. So the important points under this, this example are that there's no change to the discount rate, and there's also no change to the right of use asset. If modification accounting was applied, there would be a change to both the discount rate and the right of use asset. And the benefit of the concession would be recognised over the life of that right of use asset rather than right up front as it is in this example.
So Clark, are rent concessions always accounted for on this basis?
It's not the case that the example given is how all concessions will be accounted for. The accounting depends on a number of issues, such as the type of concession. Is it deferral? Is it a rental abatement? So the type of concession is relevant because that affects the future cash flows. The date the parties agree to the concession is also important. In the example that we've just been through, the parties agreed on 1 April 20, so prior to 30 June. If there's no agreement, then there is no rental concession to be accounted for yet. Also, another factor is whether the concession is conditional on future events. In the example given, in the previous slide, there was no conditionality, so the benefit of the concession was recognised straight away on 1 April. So as a general comment, it may be that a lessee that is merely not paying, they cannot assert that the rental concession exists and then book the benefit straight away. There needs to be an agreement between the lessee and lessor. Also, a concession where the monthly payment is reduced, but say only on the condition that foot traffic is reduced through a shopping centre by a set percentage in the relevant month, that would likely be recorded each month as the condition is satisfied, rather than at the date of agreement. So, in summary, lessees will need to carefully assess the nature of the concessions and determine the appropriate accounting. So now we'll look at government assistance. As you can see on this slide, there are various forms of government assistance which I'm sure we're all aware of. JobKeeper, deferral of payment of various tax liabilities, instant asset write-offs, etc. We've been asked by a number of clients about accounting for JobKeeper. So that's the matter that we will look at today. On this slide, we've got a summary of the JobKeeper arrangements. So as you're probably all aware, entities will receive $1,500 per fortnight payments for the government for eligible employees. If you're an eligible employer, the employer must have already paid the employees at least $1,500. There's various turnover-based requirements to determine whether or not you're eligible for the program. So there's special rules for not-for-profit entities. An issue that came up in the early days around JobKeeper that was discussed by various accountants was whether an entity was acting as principal or agent in receiving these JobKeeper payments. Our view is that as a general, in principle, or as general comment, that entities will be acting as principal and not as agent for the government. Therefore, the JobKeeper payments or receipts from the ATO will be accounted for under AASB 20 for for-profit entities. They'll be counted under AASB 120 as these payments that are being received by entities are government grants. As it says there on this slide, an entity recognises a government grant, being the JobKeeper payments, when there's reasonable assurance that the employer will comply with the conditions attaching to the grant. For example, it's paid the employees $1,500, etc., and the grant will be received. In terms of presentation, there is choice. First of all, if an entity has an existing policy for presentation of government grants, well, then the entity should follow that policy. The standard, AASB 120, allows choice for presentation. An entity can present government grants either on a gross basis, in other words, as shown on this slide, we may show other income, government grants, and then there's related expense is recognised in expenses lines in the P&L. Alternatively, AASB 120 allows net presentation, so you won't see the government grant shown as other income. It'll be offset against the salary expense. So that is a matter of choice, but I emphasise that we should look at whether the entity has an existing policy for presentation of government.
Okay, let's talk about going concern, because unfortunately, I think it's going to be an issue for many organisations in this post-COVID-19 environment. As we know, management has a responsibility to make an assessment of the entity's ability to continue as a going concern. And we know that the entity shall prepare the financial statements on a going concern basis unless management either intends to liquidate the entity or to cease trading, or has no realistic alternative but to do so. The accounting standard says that management must take into account all available information about the future, at least 12 months from the end of the reporting period. I mean, the interesting thing there is, for those organisations that are audited, you'll know that your auditors ask for 12 months of information from the date we sign the financial statements, the directors and ourselves as auditors. So there's a slight inconsistency there between the accounting standards and the auditing standards. But the point is, in a post-COVID-19 environment, looking out 12 months, is probably quite difficult, particularly if you're in Victoria at the moment, I suspect. So COVID-19 is likely to affect the level of uncertainty that may exist in an assertion that an entity will be able to continue as a going concern. The decline in demand for goods and services, the supply chain disruptions, it makes forecasting the future difficult. Where significant uncertainty exists surrounding the outcome of future events, it may be appropriate to model multiple scenarios and weigh their likelihood. I mean, this is really consistent with the discussion that we had earlier when we were talking about impairment. It's the same logic, really. So the key issues in a going concern assessment and the related disclosures include things like the sources of assumed liquidity and cash flow. Do we have lines of credit with the bank? Are they still available to us? Are we happy to tap existing shareholders? Do they even have the capacity to continue to support? And there's also assumptions that need to be made around compliance with covenants in loan agreements and contractual agreements, and even regulatory requirements and licensing requirements. If you're a builder, with a QBCC license, it might be difficult forecasting out whether you're going to still comply with those requirements, and therefore whether you still have your license to operate. Forecasting future revenue where you have significantly reduced demand for your product. And just the basic assumptions about the length of time or severity of disruptions and the suspension operations. If you own a cinema, when can you start showing movies again? And if you do like how far apart do people have to sit in the cinema? With social distancing, and how many people are you going to have in? And there's a lot of things that you have to work out. The other thing is the support that we're getting currently from various levels of government. The wage subsidies, the JobKeeper. I mean, I think the accepted view is that it finishes at the end of September, and so what happens beyond that? What about the rental deferrals? The loan repayment holidays? We're all going to have to become Nostradamus, I suspect. Of course, there are always mitigating factors, but where there is uncertainty, the mere existence or possibility of mitigating factors alone may not be sufficient to conclude that the going concern assumption is appropriate. Judgment is required by management to assess the feasibility and the effectiveness of the mitigating factors. So on this slide, we have a decision table about the various outcomes on a going concern assessment. I'm not going to talk through every single box here. Perhaps what I'll highlight is the four scenarios that are identified by the coloured boxes. The red, the orange, the blue, and that tealy coloured one. So perhaps we start at the tealy coloured one on the right-hand side. I mean, this is a position where we're basically saying there are no indicators, events, or conditions that would cast significant doubt as to going concern, and so therefore we continue to prepare the financial statements on a going concern basis. There was a question that came in from one of the participants about do you need to disclose anything if there is no impact or if it's positive? And you'll see in that little box we've said, consider disclosing the effect of COVID-19 as best practice, even if it's clear that you're a going concern. There's actually some ASIC guidance out. If you go and Google COVID-19 ASIC, and there were some frequently asked questions, and they make it quite clear that they want organisations to disclose the impacts of COVID-19, positive or negative. I mean, you may be a toilet paper company that's done really well as a result of COVID-19. So working our way around the boxes, that blue box in the bottom right corner is the outcome where you have no material uncertainty, or you've concluded that there's no material uncertainty. However, there was significant judgment in coming to that conclusion because it may have been a very close call, and therefore you're still required to disclose those key judgments that you made in coming to that conclusion. Moving around to the orange box, this is the situation where you do have material uncertainty and you have to disclose the circumstances around that and the mitigating factors, and you have to use those words, material uncertainty. And that's the scenario where we as auditors will typically include an emphasis of matter, drawing attention to that paragraph in your notes. And then finally, the red box, and I confess I don't actually see this one very often, but that's the situation where you actually determine you're not a going concern, and you have to disclose why you're not a going concern, and then you're preparing the accounts on a different basis, on a liquidation basis, on a breakup basis. So moving on, the other subject that's related to going concern, but it's not the same, is the director's solvency statement. So at least annually and half-yearly for listed entities, the directors are required to confirm that there are reasonable grounds to believe that the company will be able to pay its debts as and when they become due and payable. And when making this declaration, the directors must at least consider the capacity to pay debts which the entity has incurred at that time of the declaration. But ASIC pronouncements indicate the directors should also take into account debts which will be incurred in the foreseeable future. So again, there's three possibilities here. There's the positive position where it's yes, the director states reasonable grounds to believe that the entity will be able to pay the debts as and when they fall due. There's that third bullet point, which is the negative position. No, the directors do not have reasonable grounds to believe that the entity will be able to pay its debts. So that's a negative declaration. Or that middle situation where there's material uncertainty as to whether the entity will be able to pay its debts. Because, for example, they might have to renegotiate loans or might be subject to that. So it's a qualified disclosure. There is regulatory guidance, Regulatory Guide 22 on solvency statements, which ASIC puts out, which people should have a look at if they're in that situation. And as I mentioned earlier, ASIC has also put out a list of frequently asked questions and commentary about appropriate disclosure in a COVID-19 environment. So again, I would encourage you to have a look at that. Perhaps the final point that I'd just like to make here is the interaction between solvency and going concern. They're related, but they're not the same. And I think that the point in the blue box is made well. An entity may be solvent, so you can pay your debts as and when they fall due, but you're not a going concern because perhaps the directors have decided to cease operations and return funds to shareholders. So the directors are required to consider both going concern and solvency because they are different.
Thank you, Cameron. We'll now look at a couple of matters relating to financial instruments under AASB 9. So first of all, we'll consider modifications of financial liabilities. In the current environment, various entities may be seeking to have relief from their financiers. So they may get certain modifications to their financial liabilities, such as bank loans. This could take various forms. For example, it may be reduced interest rates, extension of contractual maturity, modification of other payment terms, and the such like. Under AASB 9, the question that you have to consider when there's been a modification to your financial liabilities is whether or not the modification is substantial or non-substantial. If the modification is substantial, you're required to de-recognise the existing liability and recognise a new liability of fair value, with the difference going to profit and loss. If the modification is non-substantial, then the carrying amount of the existing liability is adjusted to reflect the present value of the revised cash flow payments, discounted using the original effective interest rate. Again, the difference goes to profit and loss. This decision tree on this slide provides some factors to consider in determining whether or not a modification is substantial. So first of all, there's a comparison of the present value of the revised cash flows and the carrying amount of the existing liability. If that comparison shows that the difference is greater than 10%, then the modification is considered substantial. If you don't meet that test, then in our view, an entity should also consider other existing terms and whether they are qualitatively different between the modified liability and the original liability. If there's been a substantial change in these terms qualitatively, for example, there's an introduction or removal of an equity conversion feature, then a change may also be considered substantial. It may be, of course, that when you considered both the revised cash flows and the other terms, that the change may be non-substantial. So that's dealing with modifications of financial liabilities. Something that may be easily missed if you don't look closely at the changes that have you made to your arrangements during the period. Another thing where we've considered on this slide is impairment of financial assets under AASB 9. So, as we're all aware, we now have to classify certain financial assets as either being in stage 1, 2, or 3. And if you're in stage 1, then this is for purposes of determining expected credit loss. If you're in stage 1, then you recognise 12 months of expected credit loss. If you're in stages 2 or 3, you recognise a lifetime expected credit loss. You move from stage 1 to stage 2 or 3 if there's been a significant increase in credit risk. Now, the 12-month ECL or the lifetime ECL, of course, is based on the risk of default for the relevant period multiplied by the credit loss if there is a default. With the impact of COVID-19, we may see a number of changes here. For example, it may trigger a significant increase in credit risk. Therefore, moving from an asset might move from stage 1 to stage 2 or 3, and therefore move from a 12-month expected credit loss to a lifetime expected credit loss. COVID-19 may also significantly increase the risk of default due to closures, shutdowns, declines in demand, etc. And also, the amount of credit loss itself may increase due to the debtors taking longer to pay, etc. So, COVID-19 overall could give rise to a number of issues in determining ECL for loans, for example. In terms of trade receivables, often expected credit loss is based on a simplified model such as that presented here, with the matrices based on expected default rates. If the expected default rates are based on prior period loss rates, then they may not be up to date given the recent impacts of COVID-19. So the matrices may need to be revised to reflect the effects of COVID-19. It also may be appropriate to segregate your receivables into appropriate segments where certain receivables are more impacted than others. So just looking at a few other accounting issues. In terms of revenue, entities will need to assess the impact of uncertainties arising from the current circumstances on revenue recognition. For example, is there any expected increase in refund obligations? Is it more likely that the variable consideration constraint in AASB 15 should be applied to defer revenue recognition? Of course, where we introduced, or this constraint was introduced last year, and now it constrains the recognition of revenue that's variable, so that it's only recognised to the extent that it's highly probable that a significant reversal of the amount of cumulative revenue recognised will not occur. Areas such as success-based fees, construction contract delays and similar should be considered to determine whether or not this constraint will be appropriate to be applied. Another issue to consider is fair value measurement. It's important to understand that fair value is date specific. As you can see on the bottom of this slide, where we have the definition of fair value, it says that the fair value is the price that will be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. So it's date specific. So it's important that fair value be up to date as at 30 June if that's the appropriate date to measure fair value. It also may be difficult to assess fair value in the current environment, but if that's the basis of measurement, we still need to do so. It may be the case that given the impacts of COVID-19, that you need to obtain up-to-date valuations at 30 June this year, for example, for property valuations. Valuations back in December, 31 December, may now be out of date. Another point to consider in terms of fair value is disclosure. It may be that there are more management inputs that are included in fair value assessments at 30 June this year because of the impacts of COVID-19. And if they are significant, the fair value assessment may move to a level 3 in the hierarchy, which may mean that entities have to increase their level of disclosure in their financial statements. These disclosures, of course, deal with valuation techniques, inputs and assumptions. And AASB 13 does require some sensitivity analysis as well, if appropriate. Looking at AASB 2, entities may enter into some changes to share-based payments. For example, cancellations or modifications of existing share-based payments in the current circumstances. If that's the case, then we suggest that you carefully assess the impacts of those cancellations and modifications before you do them, because AASB 2 has specific requirements as to how they are to be accounted for. For example, cancellation requires acceleration of vesting. Other types of modifications can lead to other changes in the share-based payment accounting. And certain modifications are not taken into account in your share-based payment accounting either. Lastly, employee benefits. It may be the case that an entity has termination benefits or is considering terminating employees in recognition of termination benefits. You will need to carefully consider the requirements of AASB 119 in terms of accounting for termination benefits, because it has specific requirements as to the timing of recognition. As you can see on this slide, it says that termination benefits are recognised at the early of when the entity can no longer withdraw the offer and the entity recognises costs for restructuring as within the scope of AASB 137 involves payment of such benefits. There's further guidance on these requirements in the standard. So let's just look at some other financial reporting issues. AASB 16. This standard applies from 1 July 19, sorry, 1 July 19 if you're June balance date, 1 January 19 otherwise. It requires recognition of most leases on balance sheet for lessees with some narrow exemptions, low value items, short-term leases. For lessors, leases are still classified as operating or finance leases. So that classification has not totally gone away. In terms of transition, there are a number of choices there. There's full retrospective application, which we have not seen many entities at all do. There are 2 modified retrospective methods of application, which are quite different. One is simpler than the other, and they each have their pros and cons. There's new guidance in AASB 16 on identifying a lease. You have to consider whether you have an identified asset, a right to obtain substantial or all of the economic benefits, and a right to direct the use of the asset. There's new guidance on assessing the lease term, including lessee options and whether a lessee is reasonably certain to exercise those options. Many of the off-balance sheet items in the past now on balance sheet for lessees, the classic being leased premises. AASB 16 impacts EBITDA and financial ratios because with an increase in assets and increased liability, there's changes in gearing. That means that entities will need to consider the impacts on covenants and such like. AASB 16 is significantly more complex than the old AASB 117, as it deals with assessing lease term, including options, deals with assessing an incremental borrowing rate, and the such like. So there's more complexity introduced with this standard. Various of these areas require judgment. For example, do we have a lease? As I mentioned, there's new criteria for that. We may find that some service contracts in fact contain a lease, whereas under the old standards we wouldn't have identified that. What is the lease term if there's lessee options? I've already mentioned that. The incremental borrowing rate, that's an assessment for each lease. An entity does not just have one incremental borrowing rate necessarily. There are issues as to the payments to be included in the right of use asset and the lease liability. Fixed payments are included. Variable payments dependent on a rate or index are included. But variable payments that are based on usage or turnover-based payments are typically excluded. I've already mentioned transition. Finally, I should mention the systems to implement AASB 16. If you've only got a couple of leases, it may be the case that you can use Excel. But if you've got many leases, scores or hundreds, you may need a software solution to implement the standard.
We're on the home stretch now, Clark. In a glimmer of good news, and for those who missed it, ASIC in their media release on the 13th of May offered a 1-month extension to the lodgement of financial statements. It may not mean as much for the ASX listed entities who still need to lodge their Appendix 4E, their preliminary announcement, by the due date, i.e. the 31st of August. And whilst it's completely acceptable to lodge that with unaudited accounts, I do know that in my experience, there's still a lot of listed companies that get a bit jittery about lodging unaudited accounts. So it may not mean as much for the listed entities.
Some other issues are disclosure. Given the level of uncertainty this year, there'll be, in many cases, significant estimates and judgments that entities will need to make in respect to a number of areas. So it will be appropriate to consider very carefully disclosure in your financial report this year. Interpretation 23, uncertainty over income tax treatments, is effective for the first time this year. It clarifies how to apply the recognition and measurement requirements of income tax as standard when there is uncertainty over income tax treatments. For example, it requires that an entity assume that a tax authority will examine amounts it has a right to examine and have full knowledge of all related information when making those examinations. In other words, companies cannot assume a low detection risk in determining tax balances. Cameron, given your audit experience, what are some of the areas for which this could be an issue?
That's a great question, Clark. I mean, transfer pricing is definitely an area where I think it's relevant, and certainly there's been some high-profile cases with some of those large mining houses with their marketing hubs in Singapore over the last few years. I mean, the ACA tax-based resets on business combinations is probably another area. I suppose the other one would be maybe funding arrangements with hybrid instruments that involve, debt equity components. So, all simple stuff.
Well, it doesn't sound simple to me, Cameron. Some other changes to be aware of are the pending changes to the ability to lodge special purpose financial reports. So for certain for-profit private sector entities, They will no longer be able to prepare and lodge special purpose financial statements with ASIC from 2022. Instead, they'll have to prepare and lodge general purpose financial statements. Probably the key change here will be for entities that have not been preparing consolidated accounts in the past for lodgement when they've been lodging special purpose financial statements. They will need to lodge consolidated financial statements in the future. The other change to be aware of is that for periods beginning from 1 July 2021, the reduced disclosure regime, which we've been used to for some years now, are being withdrawn and being replaced by a simplified disclosures regime, which will have fewer disclosures than RDR.
Okay, with 5 minutes to go, Clark, I'm just having a look at some of the questions that people are sending through, and I've got time to cover off a couple. There's one here, it's a question about NFPs and how to account for peppercorn leases given the new requirements. Do you want to answer that?
Okay. So with peppercorn leases, when the changes to the standards, AASB 16 and the new income standard for not-for-profits, 1058, when they first came in several years ago, or were first released several years ago, there was a fair bit of discussion around the fact that peppercorn leases, the right of use asset, would be recognised under the original requirements at fair value. The lease liability would be recognised at cost, which may be a very low amount. So you might have a peppercorn lease right of use asset for $300,000 and a lease liability of $1,000. The difference would have to be recognised as income. Of course, quite a few entities weren't happy with that because you'd be recognising income straight away and then having to depreciate the right of use asset over the years into the future. Subsequent to that, the AASB actually changed the requirements, so the not-for-profit entity has an option to apply cost instead of fair value to the right of use asset, so that no gain will be recognised at initial recognition. And I'd be very surprised if many not-for-profit entities don't take up the option of applying cost. In introducing this change, the AASB described the change as temporary. So that's something which we'll have to keep an eye on in the future, because if it's only a temporary option, then I guess the question is, how long is it going to be temporary for?
Thank you for that. Do you think we've got time for another question?
Oh, I think so.
Okay, let me find another one. I mean, there's a question here about whether there are any changes for lessors under AASB 16.
Yes, because we've mainly talked about the lessee accounting, of course, in our earlier discussion. So the basic requirements for lessors have not changed. Lessors still have to assess whether a lease is a finance lease or an operating lease and apply the same accounting as they did under AASB 117. However, there are some changes in definitions in the standard and guidance that may have to be considered and that may have an impact. For example, there's a change in the definition of what is a lease. There's more guidance on lease term. Those may have an impact on lessors in their accounting. I guess in our experience, another change has been with respect to the new guidance for subleases. I'm thinking of franchisors there. So there's new guidance to determine whether sublease, so you've entered into a head lease, you've entered a sublease. There's new guidance in determining whether the subleases are operating leases or finance leases. The new guidance tells us that the decision is to be determined by reference to the right of use asset from the head lease rather than the underlying asset. So, for example, if you enter into a 4-year head lease for a building and then you enter into a matching sublease, which franchisors may do, that sublease would typically be a finance lease.
Thanks, Mark. Well done. So it's 4 o'clock on the dot, mate. I think you've earned yourself a glass of red.
Oh, thank you, Cameron. Everyone, thank you for joining us today. Hopefully this has been of benefit. There is more material on our website, including various publications and training webinars and the such like. So if you wish to look further into the matters we've discussed today, I invite you to have a look at our website. Thank you.
Thanks, guys.